Let's be honest. If you've ever felt totally overwhelmed by investing advice, you are definitely not alone. The world of finance is it's so full of noise. But what if the smartest strategy was also the simplest one? Well, today, we're going to cut through all that chaos by diving into the timeless wisdom of Burton Malkiel's classic, A Random Walk Down Wall Street. You know, this quote from Sir Isaac Newton, yeah, one of the smartest people who ever lived, it just nails the central problem of investing. After losing an absolute fortune in a market crash, he realized something profound. Predicting human behavior, what he called the madness of people, is way, way harder than predicting the movement of planets. And that's the challenge every single one of us faces. So, what does this market madness actually look like in the real world? To really get why trying to outsmart it is so incredibly difficult, we kind of have to see it in action. And oh boy, does history give us some spectacular examples of what happens when logic just completely leaves the building. When you look at this timeline, you see a pattern that just keeps repeating itself. From tulip bulbs in the 1600s being worth more than actual houses, I'm not kidding, to the dot-com bust in 2000, these speculative frenzies are not a new thing. They're a recurring feature of markets. And they're always driven by greed and this collective suspension of disbelief. And just to see how utterly absurd things can get, check this out. During the South Sea bubble, some guy opened up subscriptions for a company with this exact, ridiculously vague promise. And you know what happened? People lined up to throw money at him. He collected a ton of cash, closed up shop that afternoon, and just vanished. It's the perfect example of how rational thought can go right out the window. All right, so if the market is prone to these complete fits of madness, how are we supposed to navigate it? Well, this brings us to the book's central and honestly surprisingly simple idea. The whole idea is called the random walk theory. Now, put simply, it says a stock's next move is as unpredictable as the next step of a drunk person. You know they're going to move, but you have no clue if it's left, right, forward, or backward. The market is so efficient that it's already priced in all the available information. So today's price is the best guess. And tomorrow's news, which is what moves prices is, by definition, totally unknowable. Machiel explains that investors basically fall into two camps. You've got the firm foundation folks who believe every stock has a real, calculable value. But then you have the castle in the air crowd. They believe value is purely psychological. A stock is only worth whatever you can convince someone else to pay for it. And you guessed it, most bubbles are built on this second theory. People aren't buying a business, they're just buying the hope of finding a greater fool. The famous economist John Maynard Keynes described this perfectly with his newspaper beauty contest analogy. Now stay with me here. To win, you don't pick the face you find the most beautiful. No, you pick the face that you think everyone else will find the most beautiful. In the market, that means you're not trying to value the company. You're trying to guess what everyone else is going to guess. It's this crazy second-guessing game that just fuels speculation. Okay, so if the market is just a random walk, why do so many people, from amateurs all the way up to professionals, spend all their time trying to predict it? Well, this leads us to the single biggest obstacle to successful investing: ourselves. Malkiel uses this powerful analogy from the world of poker to make his point. Just imagine, you're in a high-stakes game. You look around the table, trying to spot the amateur, right? The easy mark, the person you're going to win money from. But after a few hands, you still haven't found them. And there's the punchline. If you can't spot the sucker, it's you. When it comes to investing, our own psychological biases so often make us our own worst enemy. They turn us into the sucker at Wall Street's poker table. And these are the mental traps that do it. We're overconfident, thinking we can pick the winners. We follow the herd. That's just FOMO, buying high in a frenzy and selling low in a panic. And our emotions, man, they make us cling to our mistakes because we hate to admit we're wrong, and we sell our successes way too early. These biases are exactly why most active investors just fail. So, if we can just accept that the market is mostly random and that our own psychology is working against us, what's the answer? This sounds a little bleak, right? Well, Malkiel proposes a solution that is both incredibly simple and incredibly powerful. The solution is to just stop trying to do the impossible. Instead of that frantic search for the one winning stock, the needle. Just buy the entire haystack. That's it. Own a tiny piece of every company in the market. And the tool for buying that haystack is something called an index fund. It's a super simple, low-cost fund that doesn't even try to pick winners. It just buys all the stocks in a major market index, like the S&P 500. By doing this, you're guaranteed to get the average return of the entire market, which, as it turns out, is actually better than what most of the experts achieve. Still not sure? Okay, consider the Beardstown ladies. They were famous investment gurus back in the 90s. They claimed these returns that just crushed the market. But then an audit revealed a simple accounting error. Whoops. Their actual return was 9.1%, which was significantly less than a boring old S&P 500 index fund. It just goes to show you even the pros struggle to beat the haystack. So how do you actually put this into practice? Because this isn't just theory, it's a practical guide to building wealth. Let's break down how you can apply these ideas to your own financial life, starting today. Malkiel lays out this beautifully simple 4-step plan. First, and this is the most important one, start saving now. How much you save matters way more than your investment returns. Second, build yourself a safety net with cash and insurance. Third, you've got to understand your own tolerance for risk, what he calls your sleeping point. And finally, automate regular investments into low-cost, diversified index funds. That's the whole game plan. This piece of advice from the legendary financier J.P. Morgan is absolutely timeless. Your portfolio should never, ever be so risky that it keeps you up at night. I mean, the whole goal of investing is to improve your life, not to add a ton of anxiety to it. Find a balance that lets you sleep well, and you'll actually stick with your plan. Ultimately, a random walk down Wall Street leaves us with this really powerful question. The game of trying to outtrade, outsmart, and outguess the market is exhausting, it's expensive, and for most people, it's a losing proposition. So maybe the truly winning move is to just refuse to play that game at all. Instead, own the market, control what you actually can control, your savings and your emotions, and just let the quiet power of the market do the heavy lifting for you.